For more than 80 years, the US dollar has sat at the center of the world economy. It prices oil, settles trillion-dollar trade flows, and fills the vaults of central banks from Tokyo to Cairo. For most of that time, almost nobody stopped to ask why. It simply worked, like electricity, like the internet, an invisible piece of infrastructure everyone relies on. But in 2026, more people are asking that question than at any point since Bretton Woods. The reason is a 5-letter acronym that keeps showing up in headlines: BRICS. Meet Elena Castillo, who runs a mid-sized import company out of Miami. She brings in coffee from Brazil, textiles from India, electronics from China, and steel from South Africa. 4 different countries, 4 different currencies on paper. Yet every single invoice she pays is settled in one currency, the American dollar. Then one morning, she opens her phone to a headline: BRICS nations have taken a major new step toward replacing the dollar in global trade. Like millions of others, she has no idea what to believe. The story of a BRICS currency has been told so many times that separating fact from noise is a full-time job. So let's separate it carefully. BRICS began in 2009 as an informal grouping of Brazil, Russia, India, China, and South Africa. Since then, it has expanded dramatically, adding Egypt, Ethiopia, Iran, the UAE, and Indonesia. 11 countries now, controlling a striking share of the world's population, oil, and manufacturing. That expansion is exactly why talk of a shared BRICS currency has reignited. For the first time, the bloc includes major energy exporters, not just industrial powers. So what happens if countries producing a huge share of the world's oil stop pricing it in dollars? That question is exactly why Washington is paying such close attention. But here's what every serious analysis agrees on going into the second half of 2026. There's still no unified BRICS currency, no banknote, no shared central bank, no launch date. The idea, floated in 2023 by Brazil's president, has not materialized into anything close to a real currency. The reasons are structural, not just political. 11 economies with different inflation rates, capital controls, legal systems, and levels of trust between them. India's central bank has signaled it won't cede monetary sovereignty. Russia says talks on a common currency simply aren't happening. South Africa's government publicly corrected reports that falsely claimed a new currency was coming. So if you saw a headline promising an imminent BRICS currency, it was almost certainly overselling the story. But that doesn't mean nothing is happening. What's actually advancing, quietly, is something narrower, a payments infrastructure called BRICS Pay. Think of it less as new money and more as new plumbing, a way to route payments around the pipes that currently run through New York and London. Alongside it sits a plan to link the digital currencies of member nations. India's digital rupee, China's digital yuan, Brazil's drex, Russia's digital ruble. A trader in Mumbai could theoretically pay a supplier in Sao Paulo without ever touching a dollar. India took over the BRICS presidency in 2026 and put this proposal on the summit agenda. It's framed not as a challenge to the dollar, but as an upgrade to slow, expensive payment rails. Linking digital currencies together is very different from creating one shared currency. No country has to give up control of its own monetary policy. There's also persistent talk of something called the unit, a proposed settlement currency backed 40% by gold and 60% by a basket of member currencies. The idea has been discussed at the New Development Bank, BRICS' own lender based in Shanghai. The gold would reportedly stay inside each country's own borders, not shipped to a central vault. Even optimistic supporters admit implementation won't arrive before the end of the decade. And gold-backed currencies carry historical baggage. The gold standard collapsed once already. Analysts describe this moment as infrastructure before currency. Member states are building the pipes first and figuring out what flows through them later. Meanwhile, a second completely separate trend is unfolding: the slow erosion of the dollar's reserve share. In 1999, the dollar made up just over 71% of global foreign exchange reserves. By the third quarter of 2025, that figure had fallen below 57%, a decline of roughly 14 percentage points over a quarter century. The money isn't rushing into any single rival currency. The euro sits around 20%. China's yuan remains surprisingly small, just a few percent. This is a story of diversification, not a single challenger replacing the dollar. And a lot of that diversification is going into something much older than any currency: gold. Central banks bought more than 1,000 tons of gold in 3 consecutive years, 2022 through 2024. Buying stayed historically elevated through 2025, somewhere between 800 and 1,200 delivered tons. Poland's central bank has been the largest buyer for 2 years running. Kazakhstan posted its largest annual gold purchase on record. China, despite reporting only modest official purchases, is widely believed to be buying far more than it discloses. Why the buying spree? It traces back to one event. In 2022, Western governments froze roughly $300 billion of Russia's central bank reserves. That single act taught every finance ministry on earth a lesson. Dollar reserves can be frozen. Gold in your own vault cannot. Gold prices reflected the pressure directly, surging more than 60% in 2025 alone. Prices pushed past $4,000 an ounce for the first time in history. They kept climbing into 2026, briefly touching above $500 an ounce. This is the quiet, unglamorous half of the de-dollarization story. It rarely makes headlines, but it dwarfs the payment story in real money moved. Now, layer on a third trend, energy. If there's one place dollar dominance was built brick by brick, it's oil. The system traces back to a 1970s arrangement between the US and Saudi Arabia, the petrodollar system. Price oil in dollars, recycle the revenue into US Treasury bonds, receive American security guarantees. For 50 years, that arrangement has underpinned global demand for the dollar. That system is now under more visible strain than at any point in decades. China, now Saudi Arabia's largest oil customer, has pushed hard for yuan-denominated oil trade, the so-called petro-yuan. Shanghai launched yuan-denominated crude oil futures back in 2018 to build the infrastructure for this shift. Saudi Arabia's central bank joined Project M-Bridge, a cross-border digital payment system alongside China, Hong Kong, Thailand, and the UAE. In 2023, Saudi Arabia and China signed a currency swap deal worth roughly $7 billion. There are unconfirmed reports Saudi Arabia is quietly converting excess yuan into physical gold through Shanghai exchanges. And yet, roughly 80% of global oil trade is still priced and settled in dollars today. The Saudi riyal remains pegged directly to the dollar, a peg maintained for more than 3 decades. Saudi officials describe their approach as diversification, not de-dollarization. The pipes for an alternative system are being built and tested. But the old system still carries most of the flow. Now, the political dimension, nothing has amplified attention on this topic more than Washington's reaction. President Trump has repeatedly threatened BRICS nations over this exact issue. In November 2024, he threatened a full 100% tariff on any country creating or backing a rival currency. He repeated the threat in January 2025, shortly after taking office. He escalated further at the July 2025 Rio summit, threatening an additional 10% tariff. He even declared, prematurely according to most economists, that BRICS was effectively dead. Several BRICS governments responded by publicly downplaying any currency ambitions. Russia said talks on a common currency simply aren't taking place. Brazil said it would not push for a common currency, focusing instead on easier local currency trade. Economists modeling a full 100% tariff found it would damage both sides, slowing growth and raising prices. Some analysts argue Trump's threats could backfire, pushing threatened partners to search harder for alternatives. Back in Miami, Elena is watching all of this unfold with very real, if modest, consequences for her business. Some suppliers now mention local currency settlement options in contract talks. Her bank has rolled out cross-border payment products aimed at cutting dollar conversion fees. More of her peers are holding small working balances in multiple currencies. None of this means the dollar is losing its grip, not even close. But it represents something new, optionality that simply didn't exist 5 years ago. And optionality, once it exists, tends to expand rather than disappear. So how dominant is the dollar really right now? It's still involved in roughly 88% of all foreign exchange transactions globally. It accounts for around half of all cross-border payments processed through SWIFT. It dominates international debt issuance, with about 70% of foreign bonds issued in dollars. It benefits from network effects. The dollar is useful precisely because everyone already uses it. No other currency offers the same combination: deep liquid markets, an independent central bank, a trusted legal system, no capital controls. The euro is held back by an incomplete fiscal union. The yuan is held back by strict capital controls Beijing shows no willingness to lift. Any hypothetical BRICS currency would need to replicate decades of institutional trust across 11 very different political systems, almost from scratch. Most economists still call a full displacement of the dollar extremely unlikely in the near term. But here's where the story has real teeth, and it has nothing to do with BRICS at all. America's own fiscal position. U.S. national debt crossed $39 trillion in mid-2026, up roughly $8 trillion in just 12 months. Annual interest payments on that debt have now crossed $1 trillion a year. Interest is now the second largest line item in the federal budget, bigger than defense, bigger than Medicare. The Congressional Budget Office projects those interest costs could roughly double again within a decade. The dollar's reserve status has historically let America borrow more cheaply than anyone else, but that dynamic cuts both ways. If foreign central banks keep reducing their dollar reserves and oil exporters keep diversifying, the math gets less forgiving. Every 10-point drop in oil revenue recycling into dollar assets could push Treasury yields meaningfully higher. So the real risk to the dollar in 2026 may be less about BRICS and more about America's own fiscal trajectory. A slow, self-inflicted erosion of trust that has nothing to do with Brazil, Russia, India, or China. So where does this leave us? The honest answer: the world is moving toward what economists call a multipolar monetary system. Not a single dramatic handoff from one currency to another. The dollar took over from the British pound across roughly 3 decades in the middle of the 20th century. This is a slower, messier fragmentation. The dollar remains the largest reserve currency for the foreseeable future. But a growing minority of trade is settling through parallel channels, some in yuan, some in rupees, some in gold. Businesses like Elena's are learning to think in multiple currencies instead of just one. Not because the dollar is about to collapse. Virtually no serious analyst believes that. But because the toolkit for international commerce is quietly expanding for the first time in a generation. Headlines promising a dramatic BRICS currency launch will keep appearing. They generate clicks. But the real story underneath is patient and structural. Infrastructure built quarter by quarter, gold accumulated ton by ton, reserve shares shifting fraction by fraction. None of these threads alone threatens to dethrone the dollar tomorrow. But together, they are reshaping what the next several decades of global finance will look like. And here's the ultimate lesson. A currency's dominance was never really about the metal, the paper, or the ledger it's built on. It has always been about trust. Trust in a country's institutions, its courts, its central bank's independence. The British pound didn't lose its crown because sterling stopped existing. It lost it because the trust and economic weight behind it eroded over decades of war and imperial decline. If the dollar's dominance erodes further, it won't be because BRICS built a shinier alternative currency. It will be because trust in the existing system quietly eroded from within. And whatever currency, or combination of currencies, fills that space will be the one that earns the world's confidence back. That's a far less exciting conclusion than a headline promising the imminent death of the dollar. But it's a lot closer to what 80 years of monetary history actually suggests is coming. Reserve currencies have come and gone for as long as organized trade has existed. The Greek drachma, the Roman denarius, the Byzantine solidus, the Islamic dinar, the British pound. Before World War II, gold itself was the primary reserve asset, not paper currency. It was only at Bretton Woods in 1944 that the dollar was deliberately installed as the anchor of the global system. That promise held until 1971, when President Nixon suspended dollar-to-gold convertibility, an event called the Nixon shock. The dollar didn't just survive that shock, it went on to strengthen its global position for decades afterward. It was never the gold backing that made the dollar dominant. It was everything built around it. Deep capital markets, an open economy, the sheer size of America's role in global trade. Every BRICS alternative on the table today is trying to solve the same problem Bretton Woods solved 80 years ago. How do you get a critical mass of countries to trust a shared unit of value? That problem has never once been solved quickly. It takes decades, sometimes generations. China has its own separate campaign to internationalize the yuan, apart from anything BRICS is doing. It built its own payment network, CEPS, as a potential alternative to SWIFT. It signed currency swap lines with dozens of central banks around the world. It pushed the yuan through its Belt and Road, lending across Africa, Asia, and beyond. And yet, the yuan's share of global reserves has grown only modestly, because Beijing maintains strict capital controls, and no reserve manager wants a currency it can't freely convert back out. China would need to open its capital account to make the yuan a true dollar rival. That's a trade-off Chinese policymakers have so far shown little appetite for making. So where are gold prices headed next? Bank forecasts for 2026 and 2027 range widely, from $4,200 to as high as $6,000 an ounce. That wide range itself tells you something. Nobody feels confident forecasting this market right now. 43% of central banks say they plan to keep adding gold in 2026, up from under 30% 2 years ago. Back in Miami, Elena renegotiated her Indian textile contract this year. For the first time, it included a clause allowing partial settlement in rupees. That would have been almost unthinkable 5 years ago. Her accountant now tracks small foreign currency balances separately, as a hedge against conversion costs. At her industry's trade conference, panels on multi-currency invoicing went from a niche session to one of the most attended. None of this means Elena is abandoning the dollar. Most of her contracts are still priced in it, but the range of tools on her desk has quietly widened. And business owners like her, multiplied across dozens of countries, are the real mechanism behind any long-term currency shift. Not a single summit announcement, but thousands of individual decisions made over years. So what should you actually watch for? Watch the quarterly IMF reserve data for the dollar's share drifting below 57, then 56, then 55%. Watch central bank gold purchases for whether the elevated pace continues or finally tapers off. Watch whether Saudi Arabia or other oil exporters take any concrete step toward non-dollar pricing. Watch actual transaction volumes moving through BRICS Pay, not just the press releases. And watch America's own fiscal trajectory, because it may matter more than anything happening inside the BRICS bloc. Put it all together, and the picture is neither a dramatic dollar collapse nor a complete non-story. It's something slower, messier, and ultimately more interesting. A genuine multi-decade transition, already underway in fits and starts. The dollar's fate over the coming decades will be decided less by any single BRICS summit.